I'm Alix Steele. Welcome to Bloomberg Commodities Edge, where we focus on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. Let's get right into the data dig and dig deep into some of the market stories of the week. Want to start with that oil inventory data in the U.S. After that massive build last week, stocks actually fell by more than 3 million barrels, with the biggest fall, no surprise, in the U.S. Gulf Coast. So the bad news, though, gasoline stocks actually up for 5 straight weeks. Does it matter? I mean, maybe not, because investors are actually all bulled up. This is a great chart from Bank of America's monthly fund manager survey and shows managers to over to underweight commodities. They are the most positive, that orange line, on the sector in a decade, and that's pushing up overall prices, that white line. And talk about prices, Bitcoin, another week, another record, this time to 23,000. Now, Scott Minerd of Guggenheim thinks prices could actually top 400,000. I spoke to Jeff Curry of Goldman Sachs for his take.
Well, if you overlay a chart of Bitcoin on the price chart for copper, they look very similar. And what do they have in common? They're both risk-on growth proxies. And I would argue that Bitcoin is the retail inflation hedge.
All right, now let's get into the ring. Exxon finally unveils emission targets. By 2025, the company wants to cut the intensity of its emissions by 15 to 20%. Joining me now, Liam Denning, Bloomberg opinion columnist from Florida. Liam, what'd the market think about this?
I think people in general are pretty underwhelmed for a couple of reasons. First off, Exxon's targets, you really had to read the fine print on what you were getting. Exxon set new targets for methane emissions in 25. They are going to start reporting their Scope 3 emissions. Those are the emissions from the actual use of oil and gas from next year. The problem they face is that it all feels a little too late and kind of grudgingly given. Other companies have moved much more quickly on this. Even Chevron, which is, by no means pivoting into energy transition territory, is already reporting Scope 3 emissions. And Exxon said it will do it, but it couldn't resist the opportunity to say that those numbers on their own don't really mean anything. So I think, particularly in light of the activist campaign that got going recently as well, this seems like, Exxon is giving a little ground on this, but it doesn't feel like the kind of strategic rethink that some people have been calling for.
Which was what's so surprising about this week, that Exxon stock was actually crushing Chevron's. I mean, it went down on the day the emissions came out. But what do you make of this?
I mean, you can make a lot of things of a short-term move in prices. It's actually, apart from March when the market completely melted down because of COVID, it's actually the biggest kind of short-run outperformance for Exxon versus Chevron in the past decade. And you can lay that at a number of things. Exxon has become more of a leveraged oil play because it's been borrowing to pay its dividends. So that's one explanation. But it's possible that even though these activists who have emerged are pretty small in the grand scheme of things, and we're still talking about Exxon here, it's possible that people are beginning to see the possibility of Exxon actually embracing some sort of strategic change. If you look at this year, in fact, the last couple of years, it's been a kind of a steady process of Exxon being forced to give ground in terms of, cutting its capex, in terms of really meeting shareholders halfway who are worried about big capex budgets, worried about the dividend. So it's possible that as we see these activists emerge, people do think that Exxon might actually, embrace more of a fundamental change in its strategy.
Liam, really appreciate it. Bloomberg's Liam Denning on Exxon. Time now for Commodity in Chief, where we delve into one topic and one person in the commodity world. And today, it's former Bank of England Governor Mark Carney's push to cut carbon. So let's say you're a big company like Walmart, targeting zero emissions from its global operations in 20 years. So part of it's going to be using things like wind, solar, and EVs. The other thing they can use, carbon offsets. Here's how they work. Company A wants to cut its carbon emissions. Company B is financing a project, say building a wind farm or switching from coal to solar plants. Now, a registry validates those carbon savings from Company B. They're real. Then a broker matches those offsets with a buyer like Company A. Company B gets their money for their projects, and Company A gets closer to meeting its emission goals. Now, this market is still tiny, about $300 million, and it can be bigger. Bloomberg NEF estimates that there are over 2,700 of these kinds of projects verified with major registries, with the potential to reduce 359 million tons of CO2 a year. That's larger than all of France's emissions. Enter Mark Carney. The ex-central banker says this market needs to grow 15 times bigger or more in 10 years, and he is helping develop it. Now, the hope is that it can help companies get to their net zero goals faster by compensating for emissions that haven't even been eliminated yet. The criticism is that it's a get-out-of-jail-free card for bad actors who promise carbon reductions that don't actually happen. Either way, you need big buy-in from big companies to drive this forward. Now, Carney told me the market should be as much as $100 billion a year, and it needs to happen fast.
We've formed a group under leadership of Bill Winters, who's the CEO of Standard Chartered, long market experience, Annette Nazareth, who was a commissioner, formerly a commissioner of the SEC, sponsored by the Institute for International Finance. We have 50 institutions all the way through the value chain for this market, from verification, production of these offsets, verification, clearing, the plumbing of financial markets, the buy side, the sell side, and companies that actually would buy these offsets. Because remember, who's using these offsets in the end? We're seeing companies around the world, Microsoft, Unilever, a huge range of companies saying, we want to get to net zero. We have a plan. Well, where are they going to get the net? These are big companies. They have high standards. They need to know that the offset's really there. We have them involved in the development of this market. So we have this core group. We've given them a tight deadline and a focus. They produced their first report for consultation last week with an aim to have a blueprint for the market by the first quarter and to have a pilot market up and running by this time next year.
So flip it for me, though. So those are the companies that are going to need the offsets. What are the companies that are going to make the offsets? Are they like companies that just go ahead and plant trees, or is there something more deeper than that? You
have that as an example. You also would have examples. I mentioned the example of avoidance of emissions. So let's say I owned a coal plant in India or Indonesia, and I wanted to take that plant and convert it, shut it down and convert it to renewable. I could be a major Indian utility, industrial. I could be, a financial investor that catalyzes that activity. Now, there's economics in that activity already, because as you know, and people watching will know that actually renewables are getting cost competitive. But the strip of reduced carbon, if I can sell that in through a market like this, because it is removal of carbon, we get the same electricity but with less carbon, then that adds to my economics, it adds to my incentives, it will add to activity, and it will also, very importantly in this, will help drive down costs in power and generation in these areas, which is something we need.
The criticism is that it's a get-out-of-jail-free card for some companies. What's the pushback to that?
Yeah, I don't buy it for a couple of reasons. First, if you have a net zero plan, one of the things we're pushing for for COP is transparency. First, companies having net zero plans, but then transparency about it. If your net zero plan is business as usual and I'm buying offsets, that's going to be clear. You're going to have to live with your stakeholders, including your shareholders and creditors. That's not a credible strategy. This is a transitional market. That's the first point. The second point is, look, we have a limited carbon budget. On some measures, it's 10 years for 50% probability of 1.5 degrees. Every ton of carbon we take out of the atmosphere adds to that carbon budget. It creates time, and it creates time for the kind of innovation that we need in hydrogen, carbon capture, direct air capture and carbon, sustainable aviation fuel, all those other areas. So this is critically important, but it's transitional. This is not the end state. As I said at the start of my answer, yeah, that cannot be your strategy. And if you think it's your strategy, yeah, you will be put in jail by your stakeholders.
Metaphorically, of course. So what will a climate-friendly house of the future actually look like? Bloomberg Green asked some architects known for their sustainability chops to pick up their pencils and imagine Europe's green future, and the results? A sunflower house built to blossom from a warm Mediterranean climate. The circular roof is petaled with solar panels that rotate around a central axis, much like a sunflower on a stem, as it follows the sun to maximize energy throughout the day. One more example is a flora house that's built on existing structures. The private areas are smaller and there's more space for urban farming. It's complete with wind turbines, solar panels, and a water system, a collection system. For more examples, very cool, check out Bloomberg.com/green. And we end on a somber note today. The gold industry lost a truly beloved name this week. George Giro of RBC passed away at the age of 84 after battling COVID. His love of gold started at an early age when it helped his family survive and escape Hungary during World War II. He started his career at the commodity brokerage Goodbody and Company, eventually serving as a NYMEX board director, member, and managing director and financial advisor at RBC Wealth Management. He always looked out for people, was never too busy to explain the complex details of the gold market. I myself learned so very much from him. George, you will be missed. This is Bloomberg.